Hey guys, today's video is for the dividend growth investors out there that are also looking for a healthy starting yield. I'm going to cover 3 of the best dividend stocks to buy right now that combine both great current yields and amazing track records of increasing their dividends over time. These are stable, large cap blue chip companies that I think represent great value in this currently very overvalued market. I own all of these stocks in my own personal dividend growth portfolio, and I am actively adding to my positions. The first stock I want to talk about is British American Tobacco. This stock trades on the London Stock Exchange under the ticker symbol BATS and is the 5th largest company on the exchange with a market cap of almost $80 billion US. It also trades on the New York Stock Exchange under the ticker symbol BTI, which is how I own the shares. BTI is a global tobacco company and the largest cigarette maker by revenue in the world. They own popular brands like Camel, Lucky Strike, Newport, and Dunhill. In this video, I'll be covering the New York Stock Exchange traded BTI. I won't be looking at the metrics of the London Stock Exchange traded version. So currently they're trading for a market price of $34.60, and they pay $2.71 annually in dividends. This can fluctuate due to currency exchange rates, giving them a current yield of 7.83%. Their forward EPS estimate for 2020 is $3.97, giving them a forward PE of 8.72, which I think represents extremely good value in the current market. Looking at the highlights of this stock, they're a robust, high cash flow, and recession-proof business. Tobacco stocks have some of the best margins and highest cash flow out of any companies in the world. Management expects EPS and revenue to actually grow this year, which is great given the current environment. This company has over 21 years of consecutive dividend increases, and they are gaining market share in combustibles and new categories. They own top brands in both value and premium categories, allowing them to target a wide base of consumers. Now, with any company comes risks, and being in the industry that it is, this stock has perhaps more risk than some others. First of all, the core of their business is cigarette sales, and cigarette volumes are declining every year and are expected to continue to decline. Now, management is combating this with aggressive investment in new categories, as they call it. That's stuff like vaping and heated tobacco. They also carry oral nicotine pouches and products like that. These are essentially new ways to consume nicotine with less adverse health consequences. This company also carries a lot of debt, but management is prioritizing reducing leverage, and they have been doing so aggressively. This may somewhat limit dividend growth in the midterm, but it should be good for the overall financial health of the company. Now, lockdown measures have impacted sales, particularly in developing markets. In South Africa, for example, cigarette sales have been completely banned, so that is a revenue source that's been completely cut off from this company. Now, I would expect these lockdowns to eventually be lifted, and I don't expect this to represent a long-term headwind to the company. They also get about 75% of their revenue from developed markets, which has actually seen somewhat of a benefit from increased lockdowns and pantry hoarding, as it's been termed. Now, the last risk factor I want to go over with this company is something that is very prevalent in the industry, and that is the risk of litigation and regulation. Obviously, this is an industry that is very highly regulated, but as the largest global producer of these products, I think that if any company is positioned to deal with this and has the experience necessary to navigate any changing regulatory environments or new potential health risks that emerge, or even the well-known health risks that are already present with products that they sell, it's a company like British American Tobacco. This company is over 100 years old and has probably more experience than almost any other company in the world with dealing with these types of challenges. Now let's just take a look at some of the dividend growth metrics for this company. So the last change to their dividend was an increase of 3.65%, which is not very big, but for a company with a current yield of almost 8%, a 3.5% raise is fantastic. And as I said before, I would expect it to continue to be low over the next few years as they continue to pay down debt. Now, their 5-year compound annual growth rate is 6.5%, which is very respectable. The 10-year is similar, but the 15-year is quite high, 10.5%. And as you can see here, I have this column showing what the yield on cost would be in 10 years if they had this growth rate going forward. So even with the lowest growth rate of 3.65%, in 10 years you'd be yielding over 11% on your money, which is great in my book. And with the highest growth rate of 10.5%, you'd be yielding over 20%, which is obviously fantastic by any metric. So this company has increased their dividend for 21 years consecutively. Their forward payout ratio is about 68%, which is a little bit higher than the 65% that management targets. Their cash flow payout ratio for the trailing 12 months is lower. And as I said before, this company is a very high cash flow business. The second stock I want to talk about is International Business Machines, ticker symbol IBM, also known as Big Blue. IBM currently trades around $125 per share and pays $6.52 annually in dividends, giving them a dividend yield of just over 5%. Their forward EPS for 2020 is $11.12, and the 2021 average forward estimate is $12.34, giving them forward Ps for 2020 of 11.3 and 2021 of just over 10. IBM is one of, if not the highest yielding and lowest valued large cap pure play tech company out there. So why are they trading so cheaply? Well, let's take a look at some of their financial metrics. Revenues and profits for this company have declined steadily since 2012. Earnings per share are down 30% since 2014, and trailing 12 months net income has declined 43% over the same period. The difference in these two numbers is accounted for by the massive amounts of share buybacks this company has participated in over this period. Over the same period, total dividends paid out have increased by over 50%. Now, obviously, this is unsustainable. This cannot go on forever. The dividend cannot grow while revenues and profits fall in perpetuity. So this is certainly a turnaround play, but I think that it represents a great opportunity for investors that are willing to put up with a little bit more risk. This company is primarily a giant networking and hardware providing company with reoccurring revenue streams from big clients. This represents the core of their business, and it is a segment that is in decline. However, they have been prioritizing new growth initiatives. They've invested heavily in cloud computing, artificial intelligence, and data and automation applications. Their new CEO, recently coming in this year actually, is a technologist who's been with the company for over 20 years and is focusing on streamlining this giant organization and focusing down more on their strategic growth imperatives. Now, what I like about this company so much is that they are a giant diversified tech company, but they also have a great dividend yield, which is incredibly rare in the industry. I think also that this current pandemic could help to accelerate the growth in some of their key segments, particularly in hybrid cloud computing. One other highlight of their business is that though their core business is declining, their client base is extremely stable. The vast majority of their clients are big companies that provide essential services, things like education, government, and finance. These types of organizations need to run in any environment, and IBM keeps collecting that cash flow in the meantime. Now, as I mentioned, there are certainly risks with this business. Their core business is in decline, and if they fail to adapt, dividend cuts will eventually follow. They also have an extremely big debt load at around $65 billion. This is a result mainly of large amounts of acquisitions and share buybacks. However, management has prioritized paying down this very quickly, and they have shown over the past year or two that they are able to do that. As a result, short-term dividend growth in this stock will likely be very low due to the paying down of their existing debt. However, personally, I can live with a 5% yield, and I believe that this company will eventually turn back to growth. This is definitely a longer-term play, though. Don't expect any sudden turnarounds with this company. I think that slowly the new segments of their business will accelerate and eventually take over as the majority source of their revenues. This could place the company in a position where they become much more highly valued and begin to grow again, as they've shown that they can grow both organically and through acquisition in these new segments, particularly in hybrid cloud computing. Now let's take a look at the dividend for this company. Their last increase was 0.62%, which is obviously quite small. They only raised it by 1 penny this year, but that is to be expected given the current economic and health environment, and that they are prioritizing reducing leverage. I would expect that the dividend growth going forward for the next few years will be quite minuscule. The 5-year growth rate of the dividend is 4.63%, which is respectable for a company yielding around 5%. And the 10-year and the 15-year are quite impressive at 9.6% and 15%. As you can see, this would yield significant yield on cost over a 10-year period. IBM has consecutively increased the dividend for 25 years in a row. Their forward payout ratio is reasonable at just under 70%, and their cash flow payout ratio for the trailing 12 months is just over 50%, which is fine. Now, the third stock I want to discuss is 3M, ticker symbol MMM. 3M is a diversified industrial giant, providing tens of thousands of products under dozens of different brand names. Popular, well-known products from 3M include Post-it notes, Scotch tape, Scotch Guard, Command strips, and NextCare bandages. This company, I feel, is the most, fairly valued of the bunch, but it is certainly a more premium company that historically has commanded a higher PE ratio. So they're currently trading for $160 per share, paying $5.76 in dividends annually, giving them a yield of 3.6%, which is respectable but the lowest out of the three. Average 2020 forward EPS estimates put them at $8.10, with $8.94 in 2021. This gives them a forward P for 2020 of just under 20, and for 2021 of 17.88. Now, these seem rather high, but this is also because earning estimates have come down. Keep in mind that this is a highly cyclical industrial company, and their price-to-earning ratios will reflect that. Going into a cyclical downturn, expect their PE ratios to appear inflated, and in a cyclical upturn, at the beginnings of one, their PE ratios will suddenly become much cheaper. So this company is probably one of the best dividend companies of all time. They've consistently raised the dividend for 62 years straight, and they've paid dividends without interruption for over 100 years. Management is clearly highly committed to this dividend and growing it into the future. Certain segments of 3M's business will certainly benefit and have benefited from the pandemic, but overall the net impact is obviously going to be much more negative. This is a company that as I mentioned, is highly cyclical. They have exposure to the auto industry, to the aerospace industry, and large international exposure as well. So there is certainly some risk there with rising tensions between the US and China and the general climate of nationalism and anti-globalism that is present in our world today. The last risk I'd like to mention with this company is just the potential for liability. We certainly saw last year that there were some cases brought up against this company related to certain types of chemicals that are used in their products with potential health ramifications. This is a giant industrial company, very well diversified with many products, and the potential for liability and new health concerns is always there. So let's take a look at the dividend for this company. As I mentioned, they've increased it consecutively for 62 years, which is an amazing track record. The last raise was 2.08%, which is quite small, but given we are going into what seems to be a cyclical downturn, that is understandable. The 5-year growth rate for this company has been 7.5%, which is respectable. And for 10 years and 15 years, it's even better at just under 11% and just under 9%. For a company with as good of a track record as this, these levels of dividend growth at a 3.6% yield are certainly good enough for me. Now, their forward payout ratio is quite high, 72.6%, and their trailing cash flow ratio is about 60%. So certainly there isn't too much room for this company to grow the dividend in the immediate future. They will need to continue to expand their business through innovation going forward in order to create more room for that type of dividend growth that we've seen in the past. But with a company like 3M, I certainly believe that they can do it. Thank you everybody for watching this video today. Let me know what you think of the stock picks. Are there any better stocks that I missed or other stocks that I should cover in the future? Don't forget to comment, leave a like, and subscribe if you want to see more content like this in the future. Have a great day. I'll see you guys next time.